Hi, good morning to everybody. I don't see people on the Zoom. I can't see the live YouTube screen window. Um, let's see. I do have the two chats though, so see what I can do here. Just to say, we're just coming up to 8 o'clock. I'll give people 5 minutes. Hi, is it Radu? Can you hear
Ah,
me?
yes, yes, that is the name. Radu Popescu. Nice to meet you.
Nice to meet you.
Yes, it's a Romanian name.
Okay, nice. Yeah, I think I'm Jewish, but I think my family, I forget that part of Europe. But I think they say that like Moldova and some parts of Russia and sort of I think
Yes.
even there's some like if you say a Jewish guy is a Galiciana, I think Galicia is like an old part of Austria-Hungary that might include Romania. I don't know. I don't know my geography.
Uh-huh. Okay. But yeah, they moved out some time ago, I suppose.
Right, right.
I mean, your family.
Yeah. I mean, my son's girlfriend is from the Cleveland, Cleveland, Ohio, here in the US, and they're definitely a Romanian family.
Okay.
Romanian, yeah. But I don't know.
Yes. You were at UBS at some point, or did I?
Yeah, yeah. Why? Were we there together? I would
Yeah, I was at UBS too. So I moved from RBS.
okay.
There was this drive to do models audit. And then when UBS submitted for CCAR, then I moved from RBS to UBS. And then I moved to model validation in UBS.
Okay.
But then I moved back to Romania in 2018.
Right.
So,
Okay,
yeah.
so in sometime after the shutdown, probably the 2020,
Mhm.
I worked just the CCAR season, one CCAR season
Mhm.
under a Czech guy here in New York, Petr Chovanec. You might know him.
No, I don't know him.
He's a
Probably, I mean, one of the reasons I moved to from internal audit to validation
right.
was that the big team was building up in New York. So I felt like there was
Yeah.
no future for me. And then, yeah, anyway, I wanted to come back to Romania, and validation seems a bit more. In audit, you have more experience. You can look at everything. And if you have some sort of curiosity about every stuff, then you are very well served.
I
And
think so. I mean, at least from the places that I've seen it, like I did internal audit. There was a quant group at Morgan Stanley. That
mhm,
was pretty much my first model risk job, and it was like right in 2012. So SR 11.7 was relatively new.
yes,
I had come from working on the Lehman bankruptcy, which I guess was sort of model
mhm.
risk, but certainly what happens when you don't manage your models. But yeah, I like it. So I've pretty much done it since I've worked with internal audit. Then I worked at Deloitte for about a year. But I think that if you're a quant, you're probably more interested in MRM just because auditors are more about it's a binary. Does the validation, was it done correctly? Was it effective? Rather
Yeah, I don't know. It depends. I can tell you how I thought about it, and I think this is the correct way. As an auditor, you need to test the controls. Okay,
yeah,
probably this is not controversial. And if validation is the main control you have over the models as a process,
right.
you need to test. by reperforming parts of this control. So it's not just, I mean, usually you don't have the tools that don't allow you, but to somehow re-implement or anything. But you can still do pretty much, at least in parts of the validation, you can do as much as you do in validation. But you don't have the same amount of time, but you can build a sort of a toy model to see how it works. You can do many things.
Yeah.
Uh, so yeah, or
No,
at least I thought it. So it was rewarding from this point of view. I didn't have the feeling that somehow someone doing validation was going more deeply than I was.
no,
No.
I agree with that. Yeah, I mean, let's see what was different. So at Morgan Stanley, the reporting line was to the CFO instead of the CRO. So that's one difference.
Okay.
I guess different
Uh,
institutions. And but
that's
the people were
unusual.
good. Yeah, I mean the guy that so I'm co-authoring this textbook, I'll explain, on model risk management, which is going to come out by academic press in about a year and a half because publishing takes forever. But but one of my co-authors, Martin Goldberg, he sort of got me the Morgan Stanley job, and the person who managed me there now is a senior reviewer on the book. So we're definitely, if you have some perspective, I'm definitely, I'll start this discussion soon because I know people have, lunch and other things to go to around the world.
Mhm.
But we do have, a book that's almost 300 pages in manuscript, and we're trying to get some feedback. We have to submit it to the American publisher, the first 25%, whatever that means. Right? Whatever we define as the first 25% has to be submitted by December 1st, which is like, tomorrow. So we're trying to so we've sent some chapters out for review. So I'd be happy to share the table of contents with you. And if you think that, from your perspective on it, it would be helpful. The idea is to have a textbook for junior financial engineers, such
Mhm.
as what I've seen, and you may have at other work, when you bring in a whole bunch of people from a Deloitte or from a KPMG, and doesn't matter, they could be in Warsaw, they could be in Bucharest, whatever, but there's always some practical things that they don't have, and that the consultancies themselves don't train them because the senior people they can't have on site. They can only have the most junior people. That's their
Mhm.
economic model. So
Yeah, there is always this. I mean, in Romanian, we had an expression that you need to steal your trade from, meaning that you learn by just being around people who
right.
know how to do it. Um, and it is true, you learn the math somehow that you need.
Yeah.
And, but then, I do remember I was in Barclays, in Barcap,
Right.
and there was a there was a meeting where someone said, so we were discussing, a new product, and the guy said it's a simple application of the Feynman-Kac theorem. And I
Right.
thought to myself, oh, I am in the right place here, because how many times you can hear that in the world of business, you know?
Exactly. No, it's great. I mean, I started in astrophysics. Let me this will be the last thought, and then I'll kick off the slideshow. I had
Yeah.
I got a PhD in astrophysics, but it was very important for me to get some more training, particularly on things like measure theory and things like that. So I did a master's at Columbia, and as part of it, Yanis Karatsas, well-known quant, did a whole thing about, and he explained Feynman cats in the first course on stochastic calculus, and pretty cool because I thought, here I am coming from physics and someone who idolizes Richard Feynman, who grew up a couple of miles from here in Queens,
Mhm.
and so
Yeah.
so it's
I did operator algebras, non-commutative geometry, stuff like that
okay.
in my
So you come
PhD
from the
stuff.
math side.
So no, no knowledge of
Well,
finance, but
yeah. I mean, people say, do you miss physics? Astrophysics. I was so much of a more data, an observer guy. I was a Kepler. someone coming up with empirical things, and now I feel more like a Newton or a Galileo or something like that. So,
Okay.
but all right. So why don't we? I'm going to go to this. I've got an audience on YouTube as well, and there's also people who will watch this as a recording on YouTube. So let me. I guess if it's just two of us, we can talk while we do this, but primarily, I guess I'll talk, so it's more of a lecture. All right, so good morning to the world. Good morning to Romania for Radu, and for people for whom it's the evening, such as in Asia, and for people who are watching this as a recording at a later date. So first of all, I've called this MRMD number 16, so I wanted to just explain myself what that means. Yes, it could be pronounced mermaid, but it stands for model risk management. And this is in coordination with a new textbook. Here's the title in yellow. The idea is, here's apparently the first textbook ever in model risk management and model validation. And it's forthcoming in 2026 by Academic Press. So the idea of these weekly Tuesday, 8 a.m. Eastern Time, 8 a.m. New York talks is to get a dialogue about these things. The manuscript is still, in flight. It's still somewhat in motion and is not yet submitted for publication, but we do have the book contract. So we're still trying out some ideas. And this talk today, some of these ideas are being considered for the book. All right, so the subject of the talk today is the interaction between regulators and bank supervisors and artificial intelligence. So I'll give a little background on that, because artificial intelligence, the way we explain it in the book, and I think the way that we think about it, has a lot of different facets, a lot of different ways of thinking about it. Both from the standpoint of the financial institution itself and from the regulator or supervisor. So then in part two, we'll talk about the requests for information, the RFIs, that regulators have been asking over the last few years. In the third case, we'll show how AI is actually being used by central banks themselves to do regulation and compliance. Then there'll be a short discussion, and I'll give context for more info. I expect the talk will take about 30 minutes, and then we'll have some time at the end for questions. Here, let me just reconfigure this. Okay. So this is background where we'll touch on the different types of AI that I mentioned a minute ago when I called them facets. All right. So I can distinguish at least three different types of AI. I'll name them all, and then I'll go back and explain them in detail. The first one is AI models that would be used in addition to conventional models or non-AI models within financial institutions. The second is AI used as a bot or some sort of enhancement to finance processes. And the third one is AI in regulation. Now that is sort of two-faced, but a part of it is what I said a minute ago, that the regulators and Basel and so on are experimenting with the use of AI to do regulation and to check compliance. So let's go back and to each item and talk about them in a little bit more detail. First of all, in 1A, and from my United States perspective, I'm mainly thinking about banks, commercial banks, investment banks, and asset managers. So that would be like mutual funds and conventional asset managers. In the US, insurance companies are regulated by states and not federal, but there's still some important points. And I will mention some of the biases in AI and how these sort of individual financial calculations, you should proceed with some care when you use AI. At any rate, within the banking and asset management world, you're looking at things like how you price and how you hedge, how you risk, uh, how you calculate risk, that is, and perhaps how you put together portfolios and evaluate portfolio performance. So type 2, as I said, is the AI as a bot. So for example, in our textbook, we talked for a while about how ongoing performance measurement, which is something in SR 11.7, could perhaps be assisted by an AI bot. It could be keeping track of that. I'll talk more about this later. One could also imagine a number of uses within model governance. For example, right now, people review the inventory manually, as we explained in our chapter on model governance in the textbook. But really, new validation should be scheduled, and we have to make sure that we've responded to past action points on prior validations. These things would be helped also by a bot. So ultimately, you would think that there would be a fair amount of update, but at least as of a few years ago, only about a third, a little bit more than a third of financial institutions actually use AI bots in this role. The final third is AI in regulation. So one thing the banks could do and the asset managers would be to check for things like anti-money laundering and fraud. Are you complying with things like the U.S. Bank Secrecy Act, and are you doing it effectively? But here again, only about a quarter of banks seem to be using it in this role. And then finally in 3C, which I'll talk quite a bit about, how regulators themselves monitor the models and the bots used by banks. Okay, so in the context of operational risk, that was something we discussed to go into prior MRMDs. There was a whole talk on op risk you can see on the YouTube playback. And so one example is type 1. So that's AI as a model. So you could use it to investigate misbooked trades, and you could therefore provision for losses. Another type would be, for example, if you care about key person risk, which we cover in the op risk chapter in the textbook, then you could make sure that people are not all getting on the same plane together or going to the same conference on the top floor of the World Trade Center. And then, you could do something, as we said before, like suspicious activity reports are required in the U.S. generally, are required when dollars are involved. If there's more than $10,000 cumulative for a given entity for a given day. So were those actually recorded? So type 3 seems to be the newest, this one of the interaction between regulators, supervisors, and AI. At the moment, as I said, it's asking questions. And I know a lot of engineering and science is about asking good questions, but that's where we are. I think the issue is that what the regulators are communicating is more that you can do whatever you want with AI. Just tell us how you're doing it. And that's like the difference between ordering a piece of red meat or maybe salmon versus ordering a piece of chicken. So if you order a steak, right, you may call it slightly something different, but by the temperature of it, like I know around 125 degrees Fahrenheit is rare. Then there's medium, so rare is red, medium is pink. Sorry, that's my best attempt at pink. And well done is gray or black, I guess. That doesn't seem to me how I would regulate. If it's a piece of chicken, obviously it can't be red, it can't be pink. You'll get sick. And it has to be done to at least 165 Fahrenheit, which I did convert. That's about 75 Celsius. So similarly, AI should be well done well. And, it should be consumed. Let's try to move this out of the way and getting it more in the way. Anyway, it should be well regulated. Okay. Now, in Brooklyn, we say things are coulda, shoulda. Sometimes you say woulda. I could have done this. I should have done this. So these are perhaps lost opportunities where AI type 3 might have helped. So, for example, Lehman Brothers, I worked on the Lehman bankruptcy, and I know that September 12th, 2008 was it. But what if coming up to that date, the bank regulators had been able to see these interrelationships, especially between a subprime lender and a Lehman or an IIG, right? It doesn't seem like a very challenging task with today's AI to do that. Sorry, too many buttons. Go back. And then another thing that we had in the aftermath of 2019 and COVID-19 was a loan program for small business. But there was a lot of fraud in that program. It was a very successful program, billions of dollars. But, almost $80 billion worth of fraud was there. Many people applied for a loan with a fake entity. So again, that's something that AI may have helped to monitor. One of the terms that comes up with this is regulatory technology, which is abbreviated RegTech. So that's a subset of SupTech, supervisory technology, even though that term is not used that much. RegTech tends to be. And it's different than FinTech. This is actually to enhance regulatory and compliance processes. So, for example, you're supposed to do a KYC, a know your customer, under things like SEC regulations. So are you really doing that? How well do you know your customer? And also in all of these, we talk about effectiveness, but we also talk about how AI might, save you money. It was the UK who pioneered the idea of RegTech almost 10 years ago. You can also ask, which regulators are focused on AI. It's primarily the UK and US regulators from what I've seen. For example, the FCA, the Finance Conduct Authority in the UK, looks at outliers, which is something that AI can help with. And in the case of the Bank of England, and this is true for the Fed and probably most central banks, just the volume of text is just ridiculous. In the US, it's a bit more, as we do here, people sort of doing independent things depending on the agency. The Fed's idea that there should be a chief innovation officer, I think, was an important and innovative step forward. Likewise, there's something called Lab CFTC at the CFTC who regulate, commodities and futures. That's the C and the F. Self-regulating organizations have done things, but primarily what I've seen is asking questions, some very recently. And so that introduces the next section. Again, steak versus chicken. This is the steak. So Treasury put out a request for information, RFI, only about a month ago, or rather the deadline was about a month ago, called on the uses, opportunities, and risks of AI in financial services. And so again, this is focusing on, here, we'll focus mainly on wholesale banking, which means the models that affect clients, not so much the individuals. Here are 3 of the 20 or so questions that they asked. 2 are on types of input data and data privacy risk. So that's under the rubric of data. Will there be more data privacy risk with AI? As we covered in the last MRMD, there's a lot of data that's needed in AI. So there may be a lot of more data privacy issues. There's also a question about vendors. Do we need third-party vendors? Anti-money laundering, for instance, there's some code out there. Even Google has some AI that it's selling to do finance. But there are risks of taking any of these on, and they might even be an open source solution or something like this. Or they might be a lockdown third-party model, which is a black box. And then at the bottom of the screen, there was a question about a specific process of operational risk management frameworks. That is the operational risk of AI. So that's almost even a type 4. Using AI for operational risk is what I focused a previous slide on. So this is now the additional operational risk caused by using AI. The other agencies in the United States are doing similar. The so-called prudential regulators, which includes the Fed and the OCC, asked a similar question 3 years ago, around the time that they designated an innovation officer. And the CFTC is a bit more targeted. Okay, so of the Treasury questions, which I showed a minute ago, now I want this out of the way. Okay. There have been some responses. There's open responses on a site called regulations.gov, where you can read the questions. The Treasury document is there as well, and you can see how people are responding. So here are some organizations you may know that have responded. So, for example, I mentioned that vendor software was a question. So the MITRE Corporation, I guess Corporation, engineering consulting, I guess you would say, acknowledges that there probably will be a lot of open source code. Later, I'll mention a Python package to do natural language processing, but there's between R and Python, there's a lot out there. And keeping all the software straight is definitely an issue, the authenticity. Let's see. On data, there's a group called the Center for the Study of Financial Market Evolution here in the US. And so, there are some issues in there also that we raise in the book, such as, covariates, which could show up as cross-correlation or as cross-covariance, let's say, between two time series. This is something that AI may be able to do better than most models, such as transformer models, which I'll mention, but I won't really get into. That's more in the realm of large language models, which we cover at the end. And then Microsoft responded specifically on the operational risk question that they don't see any particular new challenges with the op risks of AI. I'm not sure I agree 100% with that. I think it may not be a doubling of the operational risk, but I think there's at least some additional risk. There are other questions, and these go more into the retail sphere. So insurance companies for sure, but I said that we're out of scope for federal. But, lending, consumer lending, for instance, it's been found, and we mentioned this in the book, that there are biases when you use AI to do lending or to do, again, on the insurance side, to see who's qualified for a life insurance policy. That, it may preferentially pick or exclude people who are underserved, minorities, and so on like that. Where are those biases? The state of Colorado was the first one to come out, and they have a policy now that AI models cannot have this type of bias. So that affects insurance companies in the state of Colorado. Again, savings is definitely a target for a lot of this AI. Now, quants themselves may also be asking questions about this, even if they work for a regulator or a central bank. Like, for example, how do you tell that an AI model is conceptually sound within the context of SR 11.7 or the PRA's SS1/23? That's a good question. Explainability is an issue, as the OCC explained in some recent House testimony. And if you can't explain a model, you can't show necessarily that either compliance has worked or that you are complying. And there's so much data here that maybe data is outside prices, volatilities, and rates that are used in the models. Okay, so now let's take a trip to some of the ways that central banks are using AI right now to do their own activities. And some of this touches on what I might call, financial things, what banks do in trading, sales and trading, and others focus more on the economy in general. I believe most central banks, like the Federal Reserve in the United States, have multiple goals. In the US, it's to have good employment and to have low inflation. So those are two macro goals. But there's also a fair amount of financial regulation, as we explained in the book, of bank holding companies, essentially the largest banks like the Goldman Sachs's and Morgan Stanley's and so on, Deutsche. Okay, so here, and hopefully this will wake you up, even if it's whatever time of day it is for you. So I'm putting flags in to represent the countries, or in the case of Europe, the European Central Bank. So for example, Israel is using AI to look for anomalies, outliers, like on the previous slide, in derivatives. An example of something that's important to regulators in the economic sphere, in the macro sphere, say, is another great financial crisis and bank runs. So, that's a nonlinear effect. It's a runaway process. So that may be more suited to AI. That's also been studied in Latin America in central banks, and actually with a fair amount of effectiveness that the anomalies were detected, let's say, better than a human being looking at charts. One can look at and sort of digest, review documents that the institution itself may have already created. And one can also look at how people react to these things. So that's something the ECB is doing. In Malaysia, there's an attempt by looking at past explanations of something, how let's say a particular regulation or point of compliance was explained to a financial institution. Was it done in the best way possible? Was it done, this is the old question in regulation, was it done in a pro-cyclical or anti-cyclical manner? Will it make the institution become more risky if you ask them to do something which is supposed to reduce their risk, or will it become less risky? So language is important. And then, the Fed has certainly used this extensively. I don't know if this audience is familiar with the Beige Book, but this has a lot to do with how the Fed sets the Fed funds rate, so-called effective Fed funds rate, which is a benchmark rate for, at least for very short-term loans. It's the overnight rate that banks can come to the Fed window and borrow. But there's also a lot of language around that explaining those decisions. And so the effort is being gone back to go into the Beige Book and read and see if you can see patterns of a coming recession. For those who are new to the word recession, it's something that can only be determined after the fact. So being able to predict it, let's say after you've seen 2 quarters of bad growth, that's a common definition, there's a recession. Well, you don't want to wait 6 months to see that something has been a recession. You'd rather predict it right now. And then, just we're human beings, so we may miss important sentences, but AI may be able to recover those. Let's get a little bit more into the quant aspects of these AI models. So the Netherlands and Indonesia are using something called a random forest. Now, as you would expect, a forest is a bunch of trees, like decision trees that branch off. And essentially, this is a bootstrapping exercise or a sampling with a replacement from multiple trees. And then a kind of tree trimming of that, taking only a fixed percentage of those. Here I say X percent, of a certain number of features from all of the trees. And to use this, I know this is a bit abstract. It's not that easy to explain it. There's a chart on the next page that tries to do this. And not only is it not that easy to explain how to code this, but it's also difficult to explain the results to regulators and to senior management, to the board, and so on. So, but here's an example. So supposing we have a 250 by 100 case. So starting on the left, capital H with no subscript is what we have as a training set. So 250 by 100 means, like, you can think about a matrix with 250 rows and 100 columns. And those can be split by rows, but each is going to be 100 columns. Like, the columns could be the steps or what goes into making the tree. So first, let's create 3 random subsamples of that, each of the same size. And then in the individual training, we can make some decisions about how we go down those trees. And then we can go back and aggregate the results of those trees into the random forest. Israel and Germany are using what's called the Bundesbank, and the Bank of Israel are using what's called an isolation forest. And isolation, again, is getting to this idea of looking at outliers, something that's way out there. So essentially splitting off or isolating those things that are the equivalent of being, let's say, several sigma away. The chart at the bottom of the screen, X, that's marking a data point which is far from the distribution of the rest of the points. So this isolation forest is good at finding that. So if you remember what I said a minute ago, in Israel, they're looking for like anomalous or even mistakes in transactions for derivatives. The neural networks are a big topic, and they're used in 2 different flavors here. There are conventional neural networks used by the UK, South Korea, Brazil, and Indonesia, and what's called an autoencoder neural network, somewhat newer, used by Canada, the Netherlands, and Ecuador. The second category were used specifically for bank runs, as explained on a previous slide. So neural networks themselves are about, trying to work through and classify data, which and to teach a machine to do it instead of a human being. And autoencoder neural network is a little bit even more abstract. In this case, the focus is on not necessarily the input and the output, but what happens in between, the so-called hidden layers, which get you from one to the other. So rather than a figure, I think here's an example from our textbook and how you might think about, there's a lot of, you want to see a movie in the local theater. And, so how does something like Rotten Tomatoes work? If you use Rotten Tomatoes, that people look at that commonly here to see whether a movie is good. They have a rating, which is useful. But of course, the rating has to result from sifting through and filtering a lot of text. So, here are some example reviews. And I just, to summarize, the green, yellow, and red are words that I, as a human being, I know. If it says I love this movie, that's obviously a good grade. Let's say 5 stars. Okay might be 3 stars, and wasted 2 hours might be 1 star. But again, the challenging is, to do this, and as it says underlined up here, to do this correctly, minimize the number of wrong classifications, which could be tested on unknown data. The last of the methods we'll discuss is the newest, and that has to do with Gen AI, or the so-called large language models. One that's used fairly commonly is BERT, which is this is where the word transformer does come up. It's how you take something They used to be called, well, still is called sometimes natural language processing, um, which, is more sophisticated than neural networks for something like the movie reviews. Um, but you take something like this. I guess I meant to highlight this. So the Google language can tell the difference between, sorry about that, I can't click on this, but like the English word fine, I feel fine today, fine meaning good. Or in some countries, I think like in UK countries, you can say the weather is fine. We usually say the weather is good, but or she's fine or something like that. Whereas if you say she has fine blonde hair, that means, of course, fine in the sense of, thin strands of hair, right? So one thing that Google learned is by reading a sentence forward and backwards, you can more easily pick something like this up, and that's a feature of BERT. A somewhat older method and an example of open source is Lex, which was developed originally for reading lexical or legal documents and has been extended to regulatory text. Sorry if there's any name confusion. For Alexa, Amazon uses something called Lex. This is not that Lex. But another more recent product, 2018. But one of the things that they do with X within the Python module was that they pre-trained it. So they looked at, if you're not familiar with the SEC, all public companies have to make filings, typically quarterly filings, and annual filings in Edgar, which is the database of the SEC. Even hedge funds have to file. So this is about managing assets. And so they trained it on that and got some pretty good results. It's also been used in various legal contexts. Okay, so we'll go a few more minutes. I'm going to try to hold to about another 5 minutes so I can end the discussion and leave time for questions at about 8:45 New York. So this is the way I understand things on the basis of what I've shown here as evidence. So there are a lot of efforts by the regulators focused on automating their own tasks. I think that what I hear, what I see is particularly something like in the way that Basel speaks about this. There were some Basel references in the deck. I will send this PowerPoint around as a PDF. So you're free to browse it and come back to me with comments and look at it at your leisure. But for example, most of those examples of what Israel, Ecuador, and so on are doing are from based on a Basel reference. However, because it's mainly asking questions and sort of poking into the way AI is used, I don't know whether there will be actually new standards written for AI at this point. And maybe they'll conclude that the existing framework, like of SR 11.7, that you don't have to have a carve out, a specific section on AI. And so that, writing from today, I would say that AI is not being regulated in FIs, except in the sense that as part of their business as usual, ordinary processes in regulating all models. There's no specific, like extra level of regulation that's being done on AI. I personally, I think that there should be. All right, so that's pretty much the talk, and I'll give you back some time, and I'll open to questions. I'll put up the chats here, and this will also be in the in when I send around the PDF. But these are weekly talks at 8 a.m. Eastern time. They can also be live streamed either as they happen, or you can look back and archive them, all 16 of them. And here's some contact information for me. So I'm going to stop the share. Go back to the screen. Let's see if I can get back my chat windows. Okay. And I see Rod is on the Zoom, and anybody else is out there. Let's see, I should be, I don't know. That's a chat window. Okay. So there's the YouTube chat window. And if the Zoom one pops up, that's fine.
So one can join on YouTube too, or no?
Yes, you can't really interact except for this. I guess you can't see my screen, but there's a chat
Ah,
window so you could talk to me. But you could submit questions and you can follow up. But Zoom's more interactive, so it's yeah.
okay. Okay.
You can have it on and it records it automatically. And also there's kind of a cool thing that, it's good to have a junior person as a co-author. So he found out that within Zoom you can actually get AI to take minutes. So I'll send around minutes.
Okay.
And it's taking minutes right now. So yes, you have been recorded on YouTube. I guess I should say, I think I said that at the outset. So yeah.
So one question. Do we have evidence about the controls that central banks put on their AI? Because you'd expect them being so control oriented that they would have some form of validation.
I think that's like do you have the expression target state? I think that's the target state.
Okay.
But I think right now it's more the tasting and like the steak analogy that they're just sort of or I like to swim, so they're putting their toe in the water on this, but they haven't really jumped in to regulate. Is that your experience? I mean, let's say a European or Romanian perspective. Have you heard about, Baffin or because I have not. I think, maybe I read what the FCA said about it, the UK FCA, and
Mhm.
they say they're committed to it, but I still don't see anything of the level of, just sort of guidelines.
I haven't seen either, but I didn't look for it either. So
Yeah,
maybe the thing is, they usually wait for a while before they see some good established practices.
right.
Um, and then probably that will be, my guess is it will be use case by use case, not that much as a general, because they, as you pointed out, they are so different. So if you do this to somehow minimize the risk, is clearly in relation to how you use it. So
Yeah, it's even at the level, one of the Treasury questions that I didn't include is, and remember, in case people, OCC is part of Treasury. Fed is independent, but so the
mhm.
way that OCC would think about this, one of the questions with Treasury, almost like asking for an enumeration or an elaboration of in what ways is AI used at your institution. So that's more of a survey question. That's not really, you're not doing the experiment. You're preparing, it's what people sometimes say, a plan to make a plan. And
Yeah, plan for a plan that way.
yeah,
But are we even clear what they mean by AI? So,
right. Well, okay, so Treasury has a definition. I may be able to pop that up. I have that in the book. Um, but and in fact, the first question was, do you agree with this definition? So I'm happy to pull up the book, the manuscript.
it's almost like it's the fact that it's not explainable. It's almost built in somehow.
Yeah, I like the fact that Turing called it machine intelligence. He didn't call it artificial. He did not use the word artificial.
Uh-huh. Oh, yeah. Artificial means there is an art.
Well, I guess that's also Turing's, perspective that it doesn't pass a Turing test. Maybe if it passes a Turing test, then it's real, right?
Yes.
But yeah, so I can share the manuscripts. Here. It's got a lot of red ink. But if you look at so just to show you in this, what do they call it? The outline or whatever, the roadmap. Um, which one is yeah, so So the artificial intelligence chapter is here. I don't know if you can see this or I can magnify it.
Yeah.
So it
Yeah.
roughly corresponds to those three types. The use of models, the is the first one. That's a big one and covers things like how you might calculate sensitivities. This is on too many levels for me, but anyway, let's go to this one, AI and regulation. So I think I have the Treasury quote here. I definitely have the reference. Um, yeah, wrong section. No, go down. Sorry. I'm not even through my first cup of coffee, so I guess I'm,
Oh, that's tough.
yeah, maybe it's better to, and this is in Dropbox, so I'm having to scroll with the network. So here's the little wheel, right?
Yeah.
Our life is dependent on the Microsoft wheel. This is a lot about neural networks, yeah. I clicked on this section. I don't know why it sent me here. All right. Anyway, so there are about 20 questions, like I said, and then this is endless. I didn't write this, but all right. Here. Okay. Oop, and I had it up for a minute ago, and then it went away. No, there. Okay. So the term artificial intelligence has the meaning set forth. So they're actually referencing something else. This,
Okay.
this is in the Treasury request for information that just got the comments just officially the comment period concluded in August. So I don't know if this is
Yeah.
acceptable.
Like prediction, recommendation, or decision influencing. Use machine perceive real bone and everything can be done here. Yes. Okay. So it's quite a wide net, I would say.
I think it's like whatever, discovering America, discovering the New World or something. You have this new thing and you want, or the onset of the internet, you think, I have this new thing, what's the best use, the best way to regulate it?
Yeah. Oh, and it's practical. I mean, what else can you do?
Right.
Uh,
Yeah.
okay.
You can also see, I think I included them. Well, no, I think in this one I focused on the wholesale one, but about half their questions have to do with things like what what consumers, I mean, this is the United States, department. So of course we're thinking about the best things for our citizens who are consumers and to
Yes.
protect them. So it's not just about what we think about. I just,
Yeah. It justify it.
right.
Sometimes you have to protect them from very simple models.
Yeah. 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 I remember Dodd-Frank, one of the first things that came out was you probably have the same thing. Like you get a credit card and you used to get these the disclaimers that were very small type. Uh, so so that way you couldn't actually read what they would do if you miss a payment or something, right?
Yeah.
So Dodd-Frank actually there's a minimum font size.
Okay, that's a good one. Yes.
I think it's good. But I think it was like 4, which, at least
Yes.
with my eyes, that doesn't help. But yeah, so I think I covered some of these. But here's the one about, yeah, so they're asking for use cases. How does that vary across a financial institution? Like I think like we talk in the book about how even now banks don't know when a model is used. There's no thing like an RFID or something like there would be at a supermarket. We'd like to have something like that for a model so that a model, quote unquote, can know its own name. And every time it's used, it's recorded. So you don't have that for models in general. So you definitely don't have that for AI. So you don't really know, tomorrow someone might start using ChatGPT to do something. And unless you have a good model risk structure, that might be invisible or opaque. Opaque.
Okay.
And I think I mentioned the black box part too, that I got interviewed for like an anti-money laundering model, and they wanted people to debug, and they said, "So do you understand how these models work?" And I said, "Well, given that they're black boxes and they're third-party things, do you understand how they work?" You know, and just like in SR 11.7, there's a lot of question about how do you vet a third-party model. Uh, and is a third party, I worked for Numerics, like Murex, one of the
Yes, no,
big
yeah.
derivatives place, and I can tell you that very little is done in the way of showing a customer that something works. They'll do, once you sign on with them, then they'll do for a certain fee, they'll do some tests, but they're not going to send you a white paper in most circumstances. Maybe Bloomberg might, but
Yes.
so when the Fed say, how do you know that the numeric so-and-so model works? We had a lot of issues in PFE calculations when I was at Jefferies because we didn't understand, because Murex was fairly transparent. For example, they said that they were using Sobel sequences, and that made sense because it would essentially, if you're familiar with Sobel, it's mostly by the number of realizations has to be a power of 2.
Yes.
So if you said 1,000, it would say 1024. If you said 2,000, it would do 24, and so, it had to be the nearest power of 2. In numerics, it wasn't clear. I don't think we ever got a straight answer from them to what they would do if you gave them a number like 2,500.
Mm-hmm.
Because,
Okay.
if you don't have 2 to the n, so like, what do you do? Do you create, 2 to the n, then sort of randomly pick from those? And then even the idea of a seed in a Sobol, then I started getting, well, it's not really a seed, it's scrambling the whole, way they're created. So those kind of details, I mean, and then how do you measure, well, there's a whole thing in the book about how you measure that. Measure convergence and measure how much of the noise you're reducing, the variance you're reducing. Can you actually see that in third-party data? It's hard, is what I found. I don't know your experience.
Uh, have to remember that we had this problem at Barclays with measuring the reduction in variance. And yeah, I can't really remember how we do it.
What I did, yeah, what I did at Jefferies is I started thinking about my days as, in high school physics, like measuring the period of a pendulum. And so you do multiple trials of that. So what I did was, instead of thinking about a one-dimensional case of just like the rows are the increasing number of realizations, whether they're powers of 2 or whatever, 100, 1,000, 10,000, but then across the columns do different seeds.
Mhm.
Because there's a variance in each individual seed. So
Yes, so
take,
you apply the law of total variance somehow to.
right. Essentially, that's right. I would just do variance, or in my poor man's way of doing it, I would be calculating for each row the sample standard deviation and sample mean. And
And then, yeah,
and
okay.
so then I can look at that sample standard deviation as the number of realizations goes up, and you expect that to be monotonic. And then
Okay.
you could sort of pick that, because one of the issues with maybe Barclay said that too. It's like, well, what do you mean by good convergence? What is that?
Yeah, I mean, uh, I have a client who called. So yeah, it is always. I mean, it might converge up to some point and then start. You think you are out of the
Right, right,
woods,
right.
but then when you go further, you see that actually is somehow approaching that number and then start fluctuating again before reapproaching it. And
Yeah,
yeah, I don't know if there is a total solution to that. But I know that even in textbooks, you can find on option theory, you can find that analysis showing that for rather simple options.
right,
Uh,
right,
yes.
right. Yeah, okay. And then that's the other point. I can talk about this for a long time. Actually, if you're familiar with Glasserman's work on Monte Carlos, he's like
Yes.
one of my favorite people. We actually went to college together. We were the same year.
Mhm.
Brilliant. and I'm trying to.
By work, you mean his book.
His book is great, but he's also
Yeah.
like a really nice human being and grew up,
Yes.
a few miles from me in the New York area. But yeah, I'm trying to actually get a position to run the mathematics of finance program in the department that has Karatzis and has a number of people. It has
Uh-huh.
it has David Lee, as in the Gaussian copula David Lee, as an adjunct, among other people. But Glasserman is next door in the business school. Columbia's a compact. So, and I've talked with him over the years. But one thing that came up was that, because see, that's what you said. You said Monte Carlos for pricing, where what you're trying to estimate is a mean of a distribution.
Mm.
So the challenge that we had with PFE and VAR to some extent, although not too many people use VAR for Monte Carlo anymore. I think Citi still does. Most people use historical, but PFE is always simulation, and so that you're trying to get the variance reduction of an extreme value rather than the mean.
Yes.
And so we went back and forth. I went into some discussions, and I said, the law of law. I mean, Glasserman says, well, everything converges, right? So therefore, even the 99th percentile should converge. Yeah, well, there's two problems with it. The first one is, how long does that take? And the second is that now it's parametric. It depends on the distribution. Whereas the Lord's in the mean, convergence in the mean, everybody understands that everything's a normal distribution. But I don't think tails converge in the mean if the underlying distribution is, Weibel or even like a T distribution with a few degrees of freedom. So what you said a minute ago about how it seems to converge and then comes back, well, we talk about tails quite a bit in the book. We talk about, expected shortfall, for instance. And there again, you have to make an assumption. You have to assume that the functional form of how the tail falls off. And it's very dependent on what you assume for that. That's what my co-author, Martin Goldberg, wrote that section. So tails are tough. I guess NASA, I did work for NASA. People are trying to do things on the limits, on the extremes. It's hard to do.
Yes.
How many times will a plane hit?
But to come back to your third-party thing,
Right.
there is a new regulation. New, it's not new. It's in Europe, and it builds up on something that is from Basel about interest rate risk on the banking book.
Yeah.
And then they said you can use third-party models, but you need to demonstrate the understanding of their analytics. So
Right.
it's not the understanding of the results, but of the analytics. So
yeah, I need to do more work. I need to spend more time in Europe as a tourist, but I need to spend as a professional. I need to spend more. I started looking at BaFin. I thought they had some really good articles on model risk and also ECB. And there's an appendix in the book where we compare the U.S. not just to the Fed, not just to the PRA, but we potentially could do ECB and BaFin. Regulators that have really thought about model risk, as you said, even if it's just for counterparty credit or just for interest rate risk, and made statements about third parties. The opposite of that is Japan, that took SR 11.7 and basically reduced it to, like, I don't know, 5 pages. So it's not very helpful. But I do have a chart where I'm trying to compare UAE. I guess has also done a fair bit. But so I started reading those papers. The problem is that it was hard to get a general sense, because the ECB paper I read was mostly on just counterparty credit and on interest rate risk. But yeah, IR risk in the banking book, right? How important is that? Well, Silicon Valley Bank, right? And the collapse of Credit Suisse, and yeah. So yeah, it's a rich topic. People say, I'm in my low 60s. People say, are you ever going to retire? It's like, I don't know. I mean, the problems keep being out there. So,
yes. Okay.
All right. So I should give
It
you
was
back.
very nice meeting you, Jonathan.
Thanks.
And
yeah. Feel free.
I have the feeling we'll keep in touch.
Yeah. Feel free to connect on LinkedIn.
We are connected
Oh,
on
good.
LinkedIn,
Okay.
but
Yeah, there was. I guess Radu is a common name. I'm trying to sift through.
don't worry about it. It's the most common name,
Is
probably.
it okay? Yeah. Well,
I
John,
mean, Jonathan is not that rare either. Yeah.
in the Western world, because of Saint John. I mean, I'm Jewish, but in the Western, yeah, the nice thing is that Jonathan comes from two words in Hebrew. The Joe is from God, and Natan
Uh-huh.
means gift. So,
Okay. Oh, it's
yeah,
the gift from
so it,
God.
yeah. So my mother chose a name that said her son was the gift of God. Right. Just
And I think she was right. Every my mom thinks she's right.
thank you. Does Radu mean something, or is short?
I'm not entirely sure. It's of Slavic origin,
Right.
uh,
Not
and
Latin.
it might mean something like being joyful or something, but I'm not entirely sure.
Yeah.
I
They're
have
cool.
not researched that enough.
No, they're cool names like that. I
I
just
have
came up
also
with.
a second name, which is embarrassing because it's the name of a flower, but that's how life goes. So, you know,
That's
so okay.
good.
Anyway,
Have a good
so
afternoon. Yep. Good
okay,
afternoon, evening, and
okay. Thank you very
take
much.
care.